Welcome to this special abbreviated version of the Allan Small Financial Show. As always, I want to thank all of you for taking time out of your busy Christmas day to spend some time with us. I'm sure most of you woke up this morning opening up presents under the tree. I know many of you, and speaking to a lot of investors, meeting with family, friends for brunch or lunch or even dinner. I know it's a special time, and I want to thank again all of you for joining us, and wish everybody that celebrate a very merry, happy, Merry Christmas. Markets today, right, I guess for the last little while now, have been quite volatile. We've seen a lot of volatility, especially in the last week or so of December. And I thought it would be important to come out today and discuss some of the reasons for that volatility, talk a bit about interest rates, the look back on 2024, some of the great guests that we've had, and talk about what I think is important for 2025. So the show today is going to pretty much focus on those ideas. A lot of the questions I've been getting from investors are, what do you see next year? And what do I think is going to be important, at least for the start of 2025? So let's put up the topics for today's show. Fed cuts rates in December, but forecasts only 2 cuts in 2025. This caught the market by surprise last week, and we saw a big downturn in the markets on that day. And the markets sort of struggled to regain some traction and didn't really regain any traction until the end of the week on Friday. We saw markets higher down to open, but then started to move higher in the morning. So we'll talk about the Fed and what they said last week. Top 5 in 2025. Normally, we have our top 3 ideas that individual investors should be focusing on before they make their investment decisions. I thought it would be kind of different and a good idea to talk about 5 ideas, top 5 for 2025. What should you be focused on? And wanted also, as you see here, take a look back at our guests in 2024. Some of the highlights from some of our guests, not all. We had a large number of guests this past year, a great list of guests that we had. Wanted to highlight just a few and some of the things that they said that resonated with me, and I know a lot of investors that watch the show. And lastly, as always, want to try and take a couple of questions from all of you. If you have any questions, and please put them in the chat box. Be glad to get to them for the end of the show, and if not, we will answer them possibly in 2025. So without further ado, let's move forward with this special Christmas Day edition of the Allan Small Financial Show. So the Federal Reserve last week cut interest rates by a quarter point. Now, many of you are going to say, why did the market go down? We were all expecting them to cut a quarter point. It was pretty much telegraphed that that was what they were going to do. I think it was close to 100% chance that they were going to cut 25 basis points. But yet the market took this as a big negative for some reason. And on that day, the Dow Jones went down over 1,000 points. Markets lost between 2.5% and 3% in just one day. What happened? Well, I can tell you that many people believe that the Federal Reserve actually shouldn't have cut interest rates. And in fact, there were some on the Fed governors that sit on at the Fed and on the board there, and they said that they didn't believe they should be cutting. So we actually saw some dissension there. A couple of Fed governors actually did not agree with the move, and I think that started to cause a bit of ruffling of the feathers, if you will. And it was one of the first times that the Fed cut with not a unanimous decision. So that was a bit of a negative. We all believe that the Fed, because of all the talk going into the meeting, they were kind of put into a corner. They almost had to cut that one last time. And so for 2024, it looks like we're going to get a full percentage point cut. The rates coming in, the Fed funds rate coming into 2024, we're 5.25%, 5.5%. And we are going out at 4.25%, 4.5%, or if you want to take the middle range, the middle point of the range, 4.38%. So that's where we sit right now. So the fact that the Fed cut when the data actually hasn't really warranted another cut kind of leaves investors wondering, okay, well, if the Fed isn't data dependent as they say they are, what can we, I guess, expect from the Fed in 2025? They tell us they're data dependent, but yet they don't move based on the data. So a bit of a controversial situation. I know some people have actually called the Fed out and Jerome Powell out and saying, calling into question what the Fed is actually doing. The other thing that they said that the market did not like was they said the inflation was coming down overall, but it's sort of stalled in and around 2.5%, 3%, where it's been sitting for the last few months. Market did not like that either. The Fed has said because of that and because of the strong economy, strong employment numbers, that they would probably only need to cut 2 times next year. That's the base case. We'll see what actually happens, again, depending on the data. And once again, the market was hoping for more cuts next year. So the market had, unfortunately, many reasons to fall in the US. And as we know here in Toronto, TSX tends to follow what they do down in the US. And when the Fed is causing the markets down there to fall, our markets and global markets actually react negatively as well. A few charts that I wanted to show. The first one being US inflation. We see US inflation, there it is, US inflation and interest rates. So you see here 4.38% is our black line. It shows where interest rates are in the US. 3.3% is core CPI, again, Consumer Price Index, measurement of inflation. Core strips out energy and groceries and food. And then you have the headline CPI number, 2.75. So again, in that 2.5%, 3% range. You want to go next to PCE. We had a PCE reading, which is another inflation reading. That was given to us last Friday, personal consumption and expenditures. This is the more favored data that the Fed looks at to decide whether inflation is running hot or whether it is coming down. And you could clearly see here that it's pretty much flatlined in the last little while. Again, in that 2.5%, 3% range, remaining stubbornly in that range, not wanting to come down to the target, which is 2%. Although I will say that the Chicago Fed, Austin Goolsbee, made a comment late last week saying that actually, if you take a 6-month reading, the last 6 months of PCE, it actually comes in and around 2%. So that is definitely a positive. So 2.8 on the core PCE and 2.4% on PCE itself. Our next chart I want to show is what happened. As I said, the markets fell quite a bit on the day that the Fed announced their 25 basis point cut last Wednesday, and look to see what happened in the market. Dow Jones fell the least amount, but still quite a bit. S&P 500 came down in and around that 1.5%, 2% range. And the NASDAQ, which is probably your more interest sensitive index, where a lot of the tech names reside, fell in and around 2%, 3% in that range. So it was a pretty negative day. Interesting for us here in Canada, the effects of the Fed only cutting a 1/4 point and talking hawkishly, talking about how they would not be cutting as much next year. And what we've been hearing from the Bank of Canada, talking about how they will continue to cut, maybe not 50 basis points, but 25 basis points. Well, you can imagine what happened to our dollar. If the Fed is not cutting and we're cutting up here in Canada, the Bank of Canada is cutting, our dollar will continue to fall versus the US. And we have that chart here, if we can show it, which is our currency. And yeah, we actually have the broader index. So here's the US dollar moving up higher versus all the currencies. So the US dollar versus the Canadian dollar, the Australian dollar, the South Korean dollar, Indian rupee, all of them are falling versus the US dollar, which is rising. And again, that is all to do with the Fed not cutting as much, the policies or the potential policies that the new administration could put in place come the end of January when they are when they take over the White House. A lot of America First policy, and that obviously helps strengthen the dollar. The next chart that I believe we have here is actually, I can tell you, I don't think we have the chart, but it is a chart showing a 69-cent Canadian dollar. And basically, our dollar fell below 70 cents on the day that the Fed announced that quarter point cut. We've seen it bounce back slightly in that 69.5, 69.7 by the end of last week. So we saw an initial downturn because of only a 25 basis point cut and the talk hawkishly talking about interest rates going forward. We saw our dollar fall well below 70 cents, down to 69 cents. And we saw a little bit of a rebound at the end of last week. But overall, our currency continues to be hit as the U.S. is talking a lot more positively. Their economy is strong. Their retail sales are strong. Their unemployment numbers are really low. GDP growth in that 2.5%, 3% range. All that much better than how we're faring up here. And therefore, our dollar has been falling versus the US dollar. So overall, let's see what happens in 2025. The Federal Reserve talks hawkishly. They probably will only cut once or maybe twice during the course of the full year. We'll see how we start the year. Hopefully, we can end this year on a positive note with a bit of a Santa Claus rally into 2025. But overall, the Federal Reserve will continue to dominate the headlines and affect the markets in general. Now the part of the show that I like best, actually, and I know viewers of the show, investors like as well. We usually talk about the top 3 things that individual investors should focus on before they make their investment decisions. And this time, I thought it would actually be quite interesting and perhaps even new to our show that we did a top 5 list versus a top 3. And we're actually calling it the top 5 things to focus on for 2025. So the top 5 for 25, maybe that's a catchy phrase that we can use. But here they are: central banks and interest rates. What are central banks going to do? And what they do will definitely affect markets, especially the Federal Reserve. New Trump administration policies. Trump administration will take office in January, and we're going to be talking about what their policies will be and how they will affect overall markets. They're talking about cutting taxes. They're talking about deregulating or reducing regulation. But on the flip side, they're talking about tariffs and how that will affect things. So we'll have to see what happens and how things play out. Another, I guess, point that I wanted to get across to individual investors is valuation. Stock market ends the year pretty much at all-time highs. We've seen a bit of a bumpy ride the last little while, but overall, I think the markets are pretty close to their all-time highs. And so for me, valuation will be something to look at next year. Geopolitical events, obviously what's going on in the Middle East, a lot of it has calmed down over the last month or two, but we still know that the whole Israeli-Hamas situation could flare up at any point in time. The Russia-Ukraine situation continues to roll on, whether it's China and Taiwan, many different areas around the world. We see geopolitical events and there could be some flare-ups. Investors need to manage their expectations for 2025. I think it's quite important. And I talk about managing expectations all the time. I think where individual investors and their advisors, where that relationship goes astray, is when the investor has a different expectation than the money manager or the investment advisor. I think they need to be on the same page. And I try to communicate with my investors what I believe, and I will do this on our show today, what I believe you should be expecting in 2025 as far as returns are concerned. So let's move on with our first point, which is central banks and interest rates. And so, as I said, I think that interest rates will continue to fall. I think there is no doubt about that. The question is for us here, will we cut more than our neighbors to the south? Will we cut interest rates? Will the Bank of Canada cut interest rates more than our neighbors to the south? You know, we've been hearing talk from the Bank of Canada and the Fed that they're going to go cautiously with respect to cutting rates next year. We're not going to see the big cuts here in our country. And in the US, they may not do as many cuts. They already cut a full 100 points, and perhaps they only do 50 just for the full year. They did 100 basis points of cuts in the US from September to December, and maybe next year they only do 50 for the for the full 12 months. So it's going to be important, the Fed, Bank of Canada, and really all the central banks around the world to set policy that meets not only what their economy is doing, what the markets are doing, but the expectation, right? Central banks want to see a 2% inflation rate, and they're going to continue to do whatever they need to do to meet that mandate. First chart we have here for central banks and interest rates is a rate cutting spree. And we can see here, this basically shows us what the cuts have been this past year. And you can see rate cuts. You'll see the ones at the top, UK, US, Norway. The cuts are a little bit smaller. And then when you start getting down to Canada, look how big the cut has been. They're one of the largest, or we are one of the largest cuts. We've done the most cuts, it looks like, out of all the countries on this screen. You know, we were a lot higher to start the year, and now we've taken cuts down. And here's actually the next chart here I have is actually the chart I was alluding to earlier, which is our currency. Because of our cuts and because that our currency has been affected by the many cuts that the Bank of Canada has done versus the US. US hasn't moved nearly as aggressive as we have. And so what has happened is we've seen our currency really fall quite a bit. And you can see the right-hand side of that chart showing a pretty steep decline. When we took this chart last week, it was a pretty steep decline for our currency. So overall, I think the central banks in North America, Bank of Canada, and the Fed in the US will continue to cut rates. But in my opinion, I think the data is going to dictate how much they cut and how fast they cut. But definitely, cuts are in the cards for 2025. I would be very surprised if we don't see any interest rate reductions at all. Let's move to our second topic, which are the Trump administration taking office in January, and what that means for us here in Canada, for Mexico, for really all countries around the world. And as I said, it's 25% tariffs is what the new or the president-elect has been discussing. 25% tariffs on all goods coming from Canada into the US, 25% tariffs on Mexican goods, and talking about increasing the tariffs on China as well. Our first chart here will show a pretty interesting chart. US effective tariff rate by import source and all the different countries. There it is right there. You can see the most interesting part here, in my opinion, is China is well above everybody else. And as we know, the United States has really focused on China with respect to tariffs. You look at where Trump takes office on the far left, tariffs started to spike kind of, I guess, in his a couple of years into his administration. And really from there, Biden just kept everything, maybe increased it slightly, but pretty much kept the tariff policies of the previous administration, even though President Biden said, or was actually negative on tariffs. He kept those tariffs, which is interesting. And those tariffs are still in place today. And now the president continues to talk about increasing those tariffs. Here in Canada, we've been very vocal with the United States and in the media. I know Premier Ford in Ontario has been on CNN, CNBC, newscasts in the U.S. talking about how we want to work with the Americans and we want to strengthen our borders so that the president-elect, former President Trump, or soon to be President Trump, will not put tariffs on our goods. So a lot of back and forth between Prime Minister Trudeau, premiers like Premier Ford, and the Trump administration. Next chart we have here, the GDP impact of Trump tariffs in 2000. It looks like this was done December 6, 2024. But the interesting thing here is the global impact of tariff scenario on real GDP level. And the chart shows you 2025 and estimates for 26 and 27. And in most cases, if you look at Mexico, the effects of the tariffs will just continue to rise. In Canada, they rise and then they come down slightly. You look at China, continue to rise, and obviously Eurozone as well. So you can clearly see how much the effects will hit these countries, the Eurozone. You can see that the real impact on real GDP level goes negative. And I have to believe that that is definitely something that the United States does not want to see as well. They're also on that chart and the effects on real GDP on the US. So will President Trump affect his own country by putting these tariffs in place? A lot of people are thinking this is just, talk and that it won't come to fruition because of that reason, but we'll have to see. Next chart we have here, which U.S. imports from Mexico and Canada would be hit the hardest under the Trump proposed tariffs. So you can see on the far left is where the tariff rates are now or were in 2023. Obviously, the middle column shows the increase. So if it was 0.2 and now you want 25% tariffs, it's going to have to go up by 24.8. So you can see machinery, electronics, electrical machinery, transportation equipment, chemicals, fuel, metals, stone and glass, all this and many more things obviously will be affected tremendously. 2023 on the far right-hand side, you can see U.S. import value in billions of dollars. So tariffs, definitely any announcement by the administration with respect to tariffs and anything that the administration is proposing definitely is going to affect markets in 2025 if we start to see that businesses are being harmed, small businesses are being harmed because of the tariffs in Canada and even in the US, especially on those border states that are bordering with Canada, with Ontario, our province, and we know Ontario does a lot of business with the US, that will be a negative for all. So keep an eye on the commentary coming out of the Trump administration. Topic 3, valuations. First chart here shows very simply what market valuations look like as we move into 2025. PEs, S&P 500 PE ratio is at a high, and this clearly shows this. We talk about valuations on this show all the time, and I think it's something that individual investors need to focus on before you make your investment decisions in 2025. Next chart here, the S&P 500 index. You can see we've kind of come down a little bit towards the end of the year, but pretty much up from the bottom left to the top right. Next chart here is the NASDAQ, again, showing you how great of a year it has been for primarily tech stocks. And, for me, it has, it's been I guess, tech stocks have continued to lead this market, even when people were calling into question the Mag 7, the 7 largest names out there, mostly technology names. I was still saying, and I still maintain, you need to own some of those Mag 7 stocks. So the Googles, the Amazons, the Microsofts, the Apples of the world, Meta. These are the names that I think you need to look at for a growth portfolio. Some are higher value than others. Some still represent good value. And you need to do your homework to figure out which stocks those are. So I think that, yes, we're coming into 2025. Valuations are high, but I think there are still a number of ideas out there that can be bought on the cheap that still work for investors. So valuations, market valuations, something to consider when you make your investment decisions in 2025. The next topic that I wanted to touch on here, which is one of geopolitical events, right? We have a lot of geopolitical events that have affected the markets in the past, tensions in the Middle East, Russia-Ukraine situation, and one that we talk about in the investment world, probably more so than the media picks up on, which is that whole China-Taiwan situation. We know that many chip makers, Taiwan Semiconductor, the biggest global chip maker, is in Taiwan, obviously domiciled in Taiwan. And if China were to attack or try to take over Taiwan, this could be a big problem for the rest of the world. So geopolitical events, definitely something that that continue to weigh on everybody, and the hope that 2025 will be more of a peaceful year with less tension. Our one chart for this I guess topic and is one of a global backdrop, and you can see that as tensions, geopolitical risks rise, trade restrictions definitely rise with it. So you don't get as much flow of goods out of certain parts of the world. I mean, we've seen Houthi rebels, in and around Africa, blocking a lot of trade vessels carrying, shipping goods, being attacked by the Houthi rebels, as an example, causing some issues for supply chains. And supply chains are definitely affected by geopolitical events, and not to mention other things can affect supply chains as well. But geopolitical events is something that you want to just keep, I guess, in the back of your mind, that if they do flare up, it can cause some issues for the market. They tend to be short-lived, but something to consider. Last but not least on our list today is managing your expectations for next year. And I say this because, we've had 2 years now in a row of fantastic markets. If you're coming into 2025 thinking we're going to see another 25% growth, for example, I think you might be in for some disappointment. I don't believe it's going to be a negative year, but I'm looking more towards some more normalized returns. Keep in mind, U.S. markets on average, S&P averages in and around 8-9% a year, TSX 7-8% a year. So I think you should expect returns in and around that level, maybe a little bit higher, maybe 10-11%. But I think that is a reasonable expectation. First chart here, investor expectations for interest rates compared to reality. You can see here that as the Fed funds rate moves around, expectations move around with it. So as Fed funds rate or interest rates move higher, expectations kind of level off and move lower. And as expectations, or the Fed funds rate, I should say, starts to come down, the expectation starts to move up. And that's really what you can get out of this. And you can see on the far right that expectations, as interest rates have gone higher, the expectation actually was to see a recession, which we never actually had in the US. Next chart, S&P 500 historical annual returns. You can see how good the annual returns have been. The only, I guess, the one blip in the last, let's call it 6 years or so, was 2022, a big down year, which set us up for 2 great years in 23 and 2024. So expectations are, for me, as I've said, that we will see gains, but not as many gains, or not as much of a gain next year. I think if you come in with that expectation, if we see more gains, if the markets turn positive based on the Trump administration cutting taxes and deregulating, maybe Bank of Canada doesn't lower interest rates as much or as quickly, the dollar gains some strength, maybe we see our administration here, our prime minister here, cut taxes here in Canada to compete with the US. I know there's been a lot of talk about that. A lot of things can spur on growth, but I think if you have the right expectations, to me, that is what's most important. So as I mentioned off the top of the show, I thought it would be a pretty neat thing to look at, or take a look back very briefly at many of our guests that we've had on our show, making our show, and this year, one of the best years for our show that we've had since we've started about 3 years ago. A lot of great guests giving us really good information, and I thought it would be great just to circle back and hear what our great guests had to say.
Yeah, well, something, I hate taxes. I really hate them. And it just takes money out of people's pockets. I have a little philosophy that you keep money into people's pockets. They'll go out and we'll go out for dinner, buy a piece of furniture, put a renovation on. And if they have less money in their pockets, they aren't going to do that. So the really good news is we've never raised a tax. Think of that, Alan. We've never raised a tax on businesses or people in 5.5 years. We don't plan on it. We plan on getting revenue through growth. And we've seen growth. Our budget when we first walked through Queen's Park was 150 billion. We grew revenues by $52 billion through growth, not through raising taxes, through economic development and prosperity. But I get it. I hear it all the time, Alan. People are struggling right now, no matter if it's the high fuel cost, and we're going to see the federal government jack up the carbon tax, which is just, you can't even comprehend why they do that. Increasing carbon tax by 23%, taking more money out of the pockets of people because everything gets delivered. The food gets delivered to the stores on these trucks. They go get delivered products on trains and planes. But they're just gouging the people. It's unacceptable. I'll never raise a tax. I don't believe in taxes. I believe in growth and revenue.
I don't think AI is going to go away. I think it's about how do you embrace it, and it's going to continue to grow. I wouldn't be overexposed, but I have long been a proponent of you don't invest in one country, one currency, one company, one sector. And, like to me, this is an important point. If you've not gone through, as John would say, the asset allocation and made sure that it's aligned to who you are as an investor, time horizon, and risk tolerance. I too like ETFs. We have a variety of different things in the portfolio, but at this point in time, I'm making sure I'm not too exposed to the tech sector, but I'm not prepared to abandon it. That's for sure.
Look, there is no question that businesses have been through hell and back over the last number of years. And every time we think that we're on some pathway to recovery, some other shock happens to the system. And not just international shocks, we've had a few of those, but so many goals against our own net, where we put in place dumb policies and stupid regulations that seem to drag the economy back. And so there's no question we do have a productivity challenge in Canada, and the productivity challenge in Canada is not because we have a less robust, less entrepreneurial business community. It's because we are fighting with one hand tied behind our back when governments throw all sorts of crap our way with new regulations and new or higher taxes again and again and again. So we got to fix that. And that's why my organization exists, is to push for public policy changes to ensure that businesses can grow and get ahead, hire more people, and become more productive. And in doing that, bring in more tax revenue that helps fund the social services that we as Canadians seem to like.
Tim, what do you think about a flat tax as opposed to having all these different tax brackets? A lot easier, a lot simpler.
Well, I think you hit the nail on the head when you say simpler. I think that's the argument for people who are looking or suggesting that a flat tax makes sense. It is simpler for sure, but I've never really bought into the idea that it's actually very practical or necessary. For one thing, like I mentioned earlier, most of Canada's higher income earners don't actually mind a progressive tax system. It's just how progressive is it, right? How high do those rates get? So I don't think a progressive tax system is necessarily a bad thing, and a flat tax is simpler. But what I think we do need to simplify the tax system is tax reform. We have not had a Royal Commission on Taxation since the 1960s, when the Carter Commission was established, and they came up with some pretty sweeping changes to our tax legislation at that time. And that's really what we need again. And that will help to, with the view of simplifying, make the system fair if you think there are things about it that aren't fair, but to simplify it as well. I just don't really think a flat tax is going to be the right answer. I think you'll always come across scenarios where somebody needs a tax preference because of this or that or another thing, and you're going to get back to where we are again. So I'm not sure that's going to be the solution.
On the flat tax issue, I'm generally in favor. If we look at Alberta, recently had a system where they had a 10% flat tax, and they also had a 10% corporate income tax. So they were actually treating it equal across to Fred's point about neutrality and, a dollar is a dollar essentially. And, another country as well to look at is Estonia. So they currently have a flat tax across the board for their sales tax, for their income tax, and for their corporate tax at about 20%. And I believe it's actually going up to about 22% soon. But they're a very successful country, even though they're not a very well-known country in terms of their economic progress over the last 30 years or so. They have one of the highest business startup rates in the world, one of the highest in Europe. They also have a very robust economy in terms of productivity growth, very good education system and other things as well. So I'm actually generally in favor of a flat tax system, mainly due to making it a more simpler system, so that you're not punishing people as as their income rises and they're being more productive in the economy as well. Because right now there is a bit of that penalty with the progressive system, whereas you earn more money and more of it gets taken away by the government, for instance. So I do think that's something that we can look at. And part of that discussion too would be getting rid of a lot of the tax credits and exemptions in the system to make it a lot more simple, so that you're treating every dollar the same. And I think that's the really important point when we're talking about flat tax systems.
Essentially, what we're seeing is an overall economic impact of $282 million. And that's made up of the first 150-ish million, which is the transactional side. It's direct spending. So that's what visitors to the city for the concerts will spend on hotels, on restaurants, on Ubers, and on other shopping and other activities they may do while they're here. But it's the money they spend when they're here. But the good news is that money doesn't stop working just because these people then get on a plane and go home again. That's new money coming into our economy. It didn't start the day in our economy, but it ends there and then continues to recirculate. So there's another $130 million that is what we would call the induced and indirect economic impact. So for example, when we spend $100 at a restaurant on a dinner, the restaurant then turns around and respends that same money. They'll spend it on labor. They spend it on ingredients. They may hire a design firm to redesign their menus or some signage in the restaurant. That's all new spending in our economy. So that initial $100 doesn't just stop at the first transaction. It continues to work. That produces tax revenue for multiple levels of government, particularly at the federal and provincial levels. It produces labor income. So there's an enormous economic impact. And again, what's important is this is new money coming into our economy. So it's how we grow our economy. And this shows you that events are critical drivers of doing that, because people travel for what they're passionate about. So when you have an event like this, it brings thousands, tens of thousands of new people into the destination and all that spending. And this study that we did just shows you what that impact looks like.
We have not changed or increased any taxes since we've been elected, only rolled them back. So we put in a 10% manufacturing tax credit in the last budget. Everything we've done is to roll back taxes, reduce taxes, no increases whatsoever. Your hunting and fishing license didn't even go up. I mean, we are pushing hard at reducing the cost. And then we've put in sort of family friendly and business friendly and farm friendly things like the 10 cent a liter gas tax reduction. So we're all about reducing. We're going the other way on the taxes. And so that has helped us when the business community around the world looks at Ontario and sees, okay, that's the stability, that's the credibility we want in a government, is that they understand lower taxes equals better business. So I got to put a cherry on top on this one. So here we are, we pulled on every government lever possible to lower the cost of doing business. So we've reduced our own revenue by $8 billion a year. And what did that do? Put 700,000 people to work. We saw billions, tens of billions of investment come in. But here's the really interesting one. The day we got elected, our revenue in Ontario was 154 billion. So we reduce our revenue and let business grow. Today, 5 years later, our revenue is 204 billion. So our revenue increased by 33% in 5 years. Lower taxes equals higher revenue. That's the formula.
What a list of guests that we had on our show. And that's not even all of our guests. We've had even more so this past year. We just couldn't fit them all into our show. So first thing I want to say thank you to all the guests that came on our show, the guests that we just showed here. And some of the others, or all the others that unfortunately we couldn't fit into our end of year clip. We heard from the Premier and Vic Fideli talking about taxes, reducing taxes, and still yet increasing revenue to the province. And I know the Premier was saying doesn't like taxes and he will not raise taxes. So that was really something interesting to hear. Patty Levitt-Reid talking about diversification. AI is not going away. Technology. She continues to invest in it. Obviously, you don't want to put all your eggs in one basket, but definitely tech should be a part of a portfolio. Dan Kelly talking about, unfortunately, some of the poor policies that we have in place, not helping small business, productivity levels, as we talk about on this show all the time, showing that on a per capita basis, productivity is one of the lowest out there. We heard from Andrew Weir talking about the Swiftonomics, Taylor Swift, the effects on City of Toronto, 6 shows this past year, back in November, I believe. And what were the positives for the city, the province, the country? Also shows out in Vancouver as well. And last but definitely not least, we had Tim Sesnick, Jake Foss talking about flat tax, something that I think should be considered rather than having the progressive tax system and all these different tax rates and levels. And yes, for simplicity, but also I think that someone that yes could be making a little bit more money than somebody else. If they pay just a flat tax, say 25%, they would still pay more money in taxes than the other person making less money, but it would be equal and in terms of percentage. So something that Estonia, Jake Foss mentioned, is doing. So thank you once again to our great guests. And I look forward to perhaps talking with many of those guests again in 2025 and hopefully some new guests next year. And it promises again to be a fantastic year going forward. Now the part of the show where I try to take a couple of questions from the audience. And I have a bunch here that have come in over the last couple of weeks, actually. One is talking about StatsCan, and they reported a 1.9% inflation rate. What impact do you think the cooling of the inflation rate will have on the Bank of Canada's rate decision in January? Well, obviously, when inflation is low in and around 2%, its target rate, and if our economy is still sputtering and not growing, then that gives the Bank of Canada the leeway to continue to cut interest rates. Now, as we've said earlier in the show, they definitely have to be mindful of our currency. Our currency is taking it hard. So if they cut in January, Bank of Canada, and the Federal Reserve in the US does not cut, we could see our currency fall further versus the US dollar. So I think a low inflation rate allows the Bank of Canada to continue to cut rates, but I think they need to be mindful of currency. I'll take another question here. How often do you recommend to your investors to check the performance of their investments? That's actually an interesting question, not one to get too often. And I guess it's really specific to the person, how often you want to check. Some people check every day. Some people check once a month when they get their statements. And some people don't check too much at all, and they rely on their investment advisor. So I think it just depends on the person. I know in many conversations I have with my investors, some of them like to look at it on a regular basis and some do not. So I think it's specific to everybody, and you should do what you want to do. It's going to move sometimes. It's going to be volatile. So when you do check, try to keep your emotions in check yourself, because yes, sometimes it may not look as good and sometimes it may look really, really good. So you have to keep that in mind when you check. So with that in mind, I want to thank you all once again for tuning into this special edition, Christmas Day edition of the Allan Small Financial Show. I want to wish everybody that celebrates a Merry Christmas. I want to wish everybody a happy, healthy, and peaceful new year, a great year to come for everybody in 2025. We will be on the air with our first show in 2025 on January the 8th at 12 noon once again. And as I always say, and as I always leave off with, happy investing.